Here's something no real estate developer wants to hear. You didn't pay more tax because you made more money. You paid more tax because your structure never caught up with your growth. And the IRS, it was perfectly happy to let that continue. The worst part? Nothing on the tax return looked wrong. No audit, no penalty letter, no red flag. This case didn't explode overnight. It just quietly cost six figures over time. Many high-income tax problems aren't caused by mistakes. They're caused by time. Income grows, risk grows, responsibility shifts. But tax structure? It doesn't upgrade itself. When your role evolves but your structure stays frozen, tax quietly starts eating the difference.
Hold on, we're real estate developers. Projects are messy, cash flow is uneven, taxes are painful. Isn't that just part of the game?
No, that's part of the myth. High-risk businesses should be more intentional about structure, not more resigned to bad tax outcomes. This structure is extremely common in real estate development. One spouse owns equity and manages projects. The other supports operations as an employee. Other partners hold the remaining ownership. We see this setup repeatedly in development and project management S-Corp. On paper, it looks clean. And that's exactly why the problem hides so well. This structure wasn't wrong when it started. Early on, fewer projects, smaller teams, heavy owner involvement. At that stage, the salary made sense. The issue is that tax structure doesn't automatically adjust when your role changes.
Honestly, if I saw this on paper, I'd think, looks responsible, looks conservative, looks safe.
And that's where most overpaid tax lives. Not in aggressive strategies, not in missing deductions, but in numbers no one revisits. The mistake wasn't illegal. It wasn't sloppy. It was silent. One question was never re-asked. Does this salary still match what the owner actually does today? Let's get one thing straight. The IRS does not say, pay yourself as much salary as possible. The IRS says, pay a reasonable salary for the work you actually perform. Reasonable is determined by duties, time involvement, and market context, not profit size. In real estate, roles evolve. Early stage, you're on site, managing contractors, solving daily problems. High labor, higher salary makes sense. Growth stage, more projects. Delegation increases. Mature stage, your value shifts to judgment, capital allocation, and risk decisions, not hourly labor. But many owners keep paying early stage salary in a late stage business.
So we're paying ourselves like we're still swinging the hammer when we're actually approving budgets?
Exactly. And the tax code does not reward nostalgia. Here's what most people miss. Nothing about this adjustment increased audit risk. IRS analysis doesn't ask, how much did you make? It asks, what work are you doing now? What would the market pay for that role? Is profit driven by labor or ownership risk? When ownership return is pushed into W-2 wages, you're doing one expensive thing, paying payroll tax on income that was never meant to be wages. What changed in this case? Salary remained IRS defensible. Payroll tax exposure dropped. No income disappeared, it was reclassified. Annual payroll tax savings, $7,800.
So this wasn't paying myself less. It was stopping the IRS from mislabeling my income.
This isn't a pay cut. It's a correction. Before we go further, let's clarify a term people hear but rarely understand. QBI, Qualified Business Income. Here's the simplest way to think about it. QBI is the tax code saying, business profit is not the same as wages. W-2 wages are always labor. Business profit may receive preferential treatment when structure allows.
So QBI isn't a loophole. It's the IRS recognizing that owners don't earn money the same way employees do.
Exactly. If QBI were a loophole, Congress wouldn't have written entire sections defining when it disappears. QBI doesn't eliminate tax. It prevents profit from being taxed like a paycheck. Here's where many people go wrong. They think they don't qualify for QBI. In reality, they pushed all economic return into wages. When everything becomes W-2, QBI doesn't vanish. It gets crowded out. Once salary was calibrated properly, QBI eligibility returned naturally. No tricks. No loopholes.
But they already had a retirement plan. A simple plan, right?
Yes, and simple plans are simple. For a $600,000 plus S-Corp household, this barely moves the needle. The danger isn't that simple plans are bad. It's that they make high-income owners feel like they've already planned. When cash flow stabilizes and tax exposure rises, staying in simple becomes a passive decision. By upgrading to a more appropriate structure, a 401k paired with a cash balance plan, The tax code allows meaningful deferral in strong profit years. This is not for every S-Corp. These plans require stable cash flow, actuarial review, long-term commitment. But for owners already paying six figures in tax, this is often where structure finally catches up. Result in this scenario, $40,000 to $55,000 per year shifted into tax-advantaged retirement planning, not avoidance, timing, and structure. Combined impact, $45,000 to $65,000 plus dollars per year. No longer lost to outdated structure. The most expensive part isn't 1 year of overpaid tax. It's using the same structure for 10 years without ever asking whether it still matches your role. Real estate developers don't earn returns by clocking in. They earn returns through judgment, risk, and capital. When you tax ownership like labor, tax becomes your quietest and most expensive partner. Most people don't notice that partner until years later. And partners like that don't show up on the cap table. If you're a business owner or investor who wants to understand tax structure, not just deductions, you're in the right place. Welcome to Ivy Smart Tax. We don't chase tricks. We explain why structures work and when they stop. Subscribe for Real IRS logic, real case studies, and real-world tax education. These case studies are representative educational scenarios based on long-term advisory experience. All names, numbers, and details have been adjusted and are for educational purposes only. They do not constitute individualized tax advice.